We started on chapter 3 looking at the word. We did the closing, not the closing, sorry to say that, the process of the word, the working paper. We talk about the elimination process. We did all this one. Now there's other intercompany items we have to eliminate before we prepare the consolidated account. One of them we talk about, if you have to eliminate the account receivable against the account payable, you have to eliminate any advance payment from the P department or the parent company to the subsidiary company. You have to eliminate them. So apart from eliminating the equity of the subsidiary company, you have to eliminate the account receivable, advance payment, interest expenses, and dividend, and etc. So if you look at the balance sheet elimination of variety of intercompany receivable and the payable, we have to eliminate it. So if you look at the example, to eliminate the 25,000 cash that is made by P company and received by the S company, we have to eliminate them. We eliminate it by debiting the advance from the P company and getting the advance to the S company. If, for example, to eliminate the 100,000 intercompany account receivable against the account payable, we debit the account payable. I did explain why we have to debit the account, and I give an example that we have to carry the account receivable to eliminate the intercompany account receivable. So if you look at this one, give the big so we have these two companies here that P company is the parent company. P own the S company, and at the same time T company. So P company acquired 90% and 80% of the outstanding stock of S company, and the T company for 250,200 and 115,000 respectively. Immediately after the stock acquisition, the balance sheet of the two companies stand as follows. Now, this one, I'm going to do it in our exercise, the homework package, so I'm not going to waste time to do this one, but we're going to do the same thing in the class word exercise. So, like doing this one will waste time for us to do it. But the total on the date of acquisition, P company mailed a cash advance of 20,000. So there's advance cash here. We have to eliminate the cash that was mailed, and also to T company to improve the T company working capital. T company have not yet received, and therefore are not yet received recorded the amount. Then we are on the day of acquisition. P company own S company 6,000. We have to eliminate that. It's all intercompany transaction. And we are going to do it on a class exercise. So I don't want us to waste time and to do this one. So let's go back to the class exercise now and start doing some work on that. Give me 1 second here. Just give me 1 second. Okay, now I think I can do that. So I remember we did only one exercise, which is exercise 1-1. We completed exercise 1-1 is the one we completed here. So we are going to do the rest. And I think this is the last exercise that we did. So if you look at exercise 2-2 here, it gives us an option that on the 2018, Johnson Company purchased 100%. Once you get 100% here, it means that non-controlling interest. There's no non-controlling interest because they purchased 100% of the common stock of the Madison company by issuing 20,000 shares. So in order for them to purchase the company, they agreed to issue their own 20,000 shares in order to get the company, in order to get the company of Johnson. $10 per value of the common stock with the market value price of 17.50, which means that they had additional money. They have the additional money because of that. Johnson also paid, right, incurred expenses of the cash expense of 10,000 for the registration of the stocks and also the etc. Now, what they want you to do is that this is where, hold on, somebody's asking questions. No, it's okay, no problem. Jennifer, it's okay. So the company, this is where they stand before the acquisition. So they want to prepare the journal entry on the book of Johnson Company to record the purchase of the company, purchase of the common stocks of Madison Company, and it related. So it's not elimination. You are not eliminating this here. You are recording. You are recording the purchases of the. So what are they giving up? They are purchasing. So they are making the investment. The investment they are making here, they are making investment, our investment in S company, our investment in let's put the Madison Company because we know the name. So Madison Company, yeah, we are giving them the common stock to get the company. So we are crediting, not cash. We are crediting the common stock here. Okay, let me answer this question. Somebody put something there. Oh, it's okay, no problem. You are not really late. So we are giving them 20,000 shares, right? 20,000 shares here, and the par value of our share is about $10, $10 per. So how much? And therefore, that's going to create the other contributed capital because we are receiving more, which is equals to 17.5 minus the $10 multiplied by the 20,000 shares. So those with the calculator, please. And our investment here is equals to, in the company is the 20,000 shares times 17.50. Any, please, those who are, if they can give us the numbers, I'll be happy.
I got 350,000.
So 350,000. And if you break it down, this gives us, is it 200,000? And this is 150,000. Is that okay? Am I right? I'm just looking at the numbers, and that's because if 20,000 times 10 is 200,000. Yeah, so I think I'm right. So this is our the money that we invested in the company. So these are the amount that we invested in the company here. So the next one, B, is saying that now prepare then the expenses that they incur. So let's add the expenses. They also said they have the expenses, and the expenses is due to the fact that for the registration of the award. So this, what I'm going to do is that we can just take this one and subtract minus the 10,000 that was paid here and record the cash here of the award, the 10,000. Record the cash here of 10,000. So let me see if I can bring this. Just this one here. So the cash here is 10,000, which means that this one is going to be 140,000. 140,000 here. Now, B said, prepare the elimination. So you have to prepare the working papers for the elimination to eliminate the intercompany or the equity, your investment in the Madison company have to be eliminated because it's intercompany transactions. It's intercompany transactions. So we know in our working paper here, One, we are going to eliminate the common stock will be eliminated. We are eliminating the common stock here of the word of Madison Company. We are also eliminating the word, what do they have? They have the other contributed capital. So other contributed capital.
For on the first entry, part A,
Yes.
investment in Madison, 20,000 shares times 1750. I got 297,500.
You're talking about the 20,000 shares?
Yeah, 20,000
times what?
1750.
You sure? Do the calculator again.
I did it. I'm not sure why is this on.
Which calculator are you using?
I used Excel and used my iPhone, so both got the same result. I don't know.
Are you sure? Who gave us the figure here? I think who gave us this figure of the 350?
I did.
So it's good, right?
I used the Google calculator. So
okay, let me use my calculator. Let me see.
Yeah, let me check.
Yeah.
I'll check on my phone.
Yeah, let me use my calculator and see.
I got 352.
You get a 350, yeah. So
yeah, I got it 350 on my phone as well.
Jason,
I don't know what's going on with my calculators here.
Jason, throw your calculator away.
Yeah, throw it away. Exactly. The computer and everything.
Throw it away.
Oh my God. I don't know why.
We have to also eliminate the retained earnings, right? Retained, but it's also an equity. We have to eliminate the retained earnings in the Madison, their retained earnings. And they were given to us that the common stock is 160,000, right? So we are eliminating this 160,000. We are also eliminating the other contributed 87,500. The retained earnings 102,500 here against the investment. Then we carry the word investment. Oh, I can just carry the investment here. I don't know why our investment in Madison of the 350. So when you add them, you have to get 350 because there's no non-controlling interest. They purchase 100% of the company. Any questions? I think let's add them and see because we have to get that. So this is equal to the sum. Oh, this is not working. I don't know. Okay. Yeah, 350. So it's balanced. So any question on the exercise 3-2? Any question on that, please? The floor is open. I'll be happy to go back. If you want me to go back, I can go back. Any questions? Debo, any question? Fox, Julian, Jill, Jason, the rest?
No question, Professor.
Oh, it's good. Okay.
Professor, before we when we merging our companies, so we put the expense in our different entries. We was not combining. Why we are combining in this time?
We are not combining this time. This is ours when we were making the investment, right? Two things happened. One, we bought the company, right? We merged the company or bought the company. By one, issue our stocks, right? So we give them 20,000 stock here, right? When our par value, our Johnson par value was 10, but the market value was 17. So in other words, we have other contributed capital. That's what we have here. Right. Then we also pay 10,000 to register the registering and issue of the common stock. Right. We have to register the common stock and
so why we add the 10,000 in same journal entries? Remember before is the $10,000 for the expense?
Very good. Remember chapter 2 that if the company pay cash, right, for the stocks, right, professional fee for the registration of the fee, we have to take it out from the other contributed capital because it's related to the issue of the stock. Or maybe like the broker, let's use the broker who look for the share for us. So we are registering the stock. Therefore, it should come from the other contributed capital. That's why we are subtracting this one from the other contributed capital here.
Okay.
Does that make sense now? If it's the professional fee, then we separate it. Right? If there may be the attorney fee, accountant fee, then it's a professional. Then we debit the expenses, and then we credit the cash. But this is related to the issue of the stocks. That's why it affects the other contributed capital. Okay, that's a good question. Thank you. Now let's look at the next one here. So this company also, they want to prepare before you prepare the consolidated account. The company here purchased 90%. This is very important, which means that we have to record the non-controlling interest of the Sky stock of the stock of the Sky company. They pay cash of 96,000 just before the acquisition. The balance sheet of the two companies were as follows. So we have the Moon Company and the Sky Company. Remember, Moon is the parent company. Sky is the subsidiary company. Our investment is 96,000. We have to eliminate this before we prepare our consolidated account. Before we prepare the consolidated account. So the journal entry said A, they want you to prepare the journal entry. A said prepare journal entry to record the purchase of the stock, right? Purchase of the Sky Company common stocks. And B, prepare a consolidated balance sheet at the date of the acquisition. So we are making an investment here. So part A, we debit our investment in the Sky. This time we are not giving them the stocks. We are giving them actual cash. We are paying cash here. We are paying 96,000. Let me see if I can make this little. We are paying 96,000 here. 96,000 here. That's how much we are paying. The cash, we are paying this one. Let's see if I can bring this a little more here. Then the consolidated will vanish. Okay, so this is how much cash we are paying here. So we have recorded our investment. The second journal entry is that we have to eliminate this investment before we prepare the balance sheet. Before we prepare the balance sheet here, we have to eliminate this intercompany. We have to eliminate this amount here. So our working paper here, which one? Now, let's see here if anything was said here. So they said something here. Let me see here. I think, give me 1 second. Oh, sorry. I don't need to do all this thing. Give me 1 second. Okay. So the fair value of the Sky Company asset liability are equal to the book value except the land. So which means that if there's any difference between your working paper, the debit and credit, you have to attribute it. Attribute that one. Please give me 1 second, please.
Professor, you're on mute.
You. Just one
And you said
second.
a minute.
Yeah, a minute. I'll be with you.
Sorry.
I'm so sorry. It was some call. I have to pick it up. So I'm so sorry. So remember, they told you that if there's anything that's difference here, it's because of the what? The land, which means that if there's anything, we have to relate it to the what? To the land. So let's first one. I'm going to normally it's good to normal it. So let's add this is what the working paper one, right? You are eliminating what? The common stock. You are eliminating the what? The common stock. Sky common stock. Not only that, you look at it here, they also have the word other contributed capital. So you are eliminating the other contributed capital here. So we are going to eliminate the word other contributed capital here of the Sky. We also have to eliminate, they have the word retained earnings. So we eliminated the retained earnings of the Sky company. So if you look at the common stock, their common stock is 35,000. So we are eliminating the 35,000 here. They also have the other contributed 10,000 are to be eliminated. They have the retained earnings of 47,500 have to be eliminated. So we have not done yet. Now we have to eliminate it again, the investment. So investment, our investment in the Sky had to be eliminated. Our investment is equals to, we invested 96,000. Then non-controlling interest have to come in. So because why? We have less than 100% non-controlling interest, which you guys know already. I can do it inside first. Determine your implied value, which is the what? Your investment divided by your percentage, 0.90, times the what? The percentage of the what? The non-controlling interest, which is a 10%. 10% here. So how much do we have? How much do we have? Those with the calculator, how much the non-controlling interest in this case? Divided by 0.9 times 0.10. Is it 10,000? Somebody can write, is it?
I got 10,666.
6, so let me make it 6, 7, right? How many is
Yeah.
6, 7? So
Yeah.
run it to 6, 7 here. Now, I want to go back because last week somebody asked a question and I really love that question. With a guide here. Remember, I was asking, why do we have the word here? There was again here. So I want to do this one again. I'm going to put here and see. I'm going to copy it's not going to happen because it doesn't allow me to paste anything here. Let me see if it's going to allow me to do that. Oh, okay, good. So first, we have to get the book value, right? So let's look at the book value of this company first, because always we have to compare the book value to the implied value. If the implied value is greater than the book value, then it's a what? It's a goodwill, right? Or the difference is known as the goodwill, and we have to allocate it to to whatever they want you to allocate it. So if here, I'm going to take this one here. Let me see this one. Okay, so I'm going to change this one. Okay, so now let's look at the book value here. The book value here is the what? The 35,000, which is the common stock, plus the what? The 10,000 here, plus 47,500. Can somebody tell us how much is that? How much the book value here? How much will be the book value here? And then the implied value here is what? 96,000 divided by 0.9. So how much do we have?
2,500 for the
Which
book
one?
value. The
How
book
much?
value.
How much?
92,500.
92,500. Now let's compare to the what? To the implied value. How much the implied value?
$106,667.
106,667, right?
Yes, please.
Okay, so how much the difference? So you can see that the implied value is greater than the what? The book value. Therefore, the difference will be created on the debit side, right? So how much is the difference here? How much the difference? Difference between IV, implied value, IV.
It's 14,167.
167.
Very good. And the book
It's working
value.
now. It's working now, Professor.
Yeah, it's working now. So we see the difference here will become the 14,167, right? It's good.
Yes.
So which means that the difference here, we are going to take this difference, put it here, that the difference here, I don't know why sometimes it works. So this is what the difference. I'm going to put a difference here. Between IV and the what and the book value. The difference is a what? 14,167. And that is where they were telling you here that if there's any difference here, if you look at the difference here, the difference is due to the land. Therefore, we are going to do 2 here. I'm going to do the journal entry, second one, to eliminate the what? That transaction, to eliminate the difference. So the difference here is on the credit side. So we are going to debit. Here we are going to debit the land. So that's what they said. If there's any difference, it's because the value of the land is different from the fair value. Then carry the word the difference between IV and the word the book value. And the book value, which is this one, is 14,167. 14,167. Any question before I continue? Any? I have a time. I don't want to rush. I always want to take my time. Like I told you in the beginning of the class, the understanding is what is important to me. So any question before I continue? Okay, now we can prepare the balance sheet. So in the balance sheet, we know we have the cash. So I'm going to put the cash. We have account receivable. So let's look at the cash. The cash is they have 130,000. So 130,000 plus 32,000 minus the cash investment of 96 that we have eliminated. So how much is the cash here? Then we go to account receivable. Account receivable here. how much the account receivable here? We have 71,000 plus 11,500. So how much the account receivable? Then we have when you finish, let me know. I'll just enter the number. We have the inventory, which 58,500 plus 27,000.
Cash is 66,000.
66,000. Okay. What about account
The
receivable?
accounts receivable is 82,500.
Thank you. 82,500. What about the inventory?
85,500.
85,000. The inventory. Thank you. The inventory is 85,500. Give me 1 second. I just write this. Okay, 80 is 85, right? 5,500.
Yeah.
Then the next one is what? Plants and equipment. We know it's a net, which means that after the depreciation, which we have 193 plus 49,000. So how much do we have?
242,000.
42,000.
Okay, 240,000.
42.
42, okay. Give me 1 second and I'll... Two for 500. Yes, then we have land. Okay, I need help here. So how much is the land now? Who can tell me? Because I want to see if you guys really understand. Land, we have 31,500 plus 16,000. Is that all?
Professor, are we going to add the 14,000?
Very good. Very good. We are not going to add the 14,167 because that's what we were told here. That everything is the same except that the land has a different. That's why we allocated, and it's on the debit side. Therefore, we have the 31,500 plus 16 plus the difference between your implied value and the book value, which you related it to the you allocated it to the land. Therefore, how much the value of the land now?
61,667.
667 here. So let's add the total. What is the total asset here? How much this company their asset? What is the total asset? What is their total asset here? Oh, let's see if I think I can do that. But verify for me is equal to the sum.
$537,667.
537. So I agree.
Professor,
Yes.
the plant and equipment is 242,000 without the 500, I believe.
This
500.
this one, right? So 242, right?
Yeah.
Like this? Okay. Okay, good. So now, thank you so much. Now it's balanced, right? Now we have this one here. Now we have to do the asset, the liability now. So let's take the word the liability.
So then, Professor, it's going to be 537,167.
This one, right?
Yeah, the total.
No, this is good. Because remember, there was something wrong here. So because I use the Excel, once it's fixed, it translates. So it should be 537,667. try it and see. Add the numbers and see. Add it.
Yeah, Professor, that's right.
Good. Then we have the what? The account payable, right? They have the account. So let's put it here. Account payable, which we have P company is 52,000 plus 23,500. Then we have the mortgage payable, 36,000 plus 19,500. Then I think we have common stock. But when you're ready, you can give me the numbers. Common stock.
Installed accounts payable.
How much account payable? Give me the number.
75,500.
75,500. Oh, sorry, 75,500. And the mortgage?
55,500.
55,500. And very good. You see, on a common stock, remember, we eliminated this one. So the common stock is a what? 200,000 of the what? The parent common stock, because we have eliminated the what? That amount. We have eliminated that one. Now, the next one is a what? The other contributed capital. This capital here. We have eliminated, also we have eliminated the what? The parent, the subsidiary company. We have eliminated that. So we have to change that one. Give me. This is equal to the what? To the 104,000. 104,000. Then we have the what? The retained earnings. Retained earnings. I'm just going to change here. Retained earnings, which is a what? 92,000. Yeah. The last is a what? Non-controlling interest. Non-controlling interest, which is, we found it here, 10, 6, 7 here. So this one should be the total liabilities. So our total and stock holders equity. How much do we have? Those with the calculator, if you can help us. How much do we have for that? So this is equal to, let me see, somebody.
537,667.
So it balance. So your debit must equal to your credit, not the debit. Your asset must equal to the what? The liabilities and also the what? The owner's equity. Any question on this one, please? Any questions? The floor is open for any questions before I move on. Any questions? Any? Okay, so good job. Let's go to the next one. So if you look at the next one here, they want you to prepare. Now, this one is not really necessary to do it, but I always do this one to help the student to know where they are going. Once you do the journal entry and elimination, it's okay. You don't really need to do this one because you see here, say any difference between the book value of the equity and the value implied by the purchase price is related to the goodwill. So if there's any difference between the two, add it. It means that it should be assigned to the goodwill. It should be assigned to the goodwill. So let's see here. On January 27, P Company issued $750 on $820 per value common share with the fair value of the 60. So they are getting extra money on the investment in exchange for the 2,000 outstanding common share of the S company. See, registration costs amounting to $850 are also paid in cash. They paid in what? In cash. They paid this one just before the acquisition. This is where they stand. So, one, you have to record the word. A said record the word. Any prepare in the journal form and of the P company. And I think B said prepare the word competition here. They ask so we can do it. But normally in the number they don't ask in the test, you don't need to do it. Then prepare the word consolidated word account. Prepare the consolidated account. So let's do the journal entry of our investment. We debit the investment, right? Because we are investing money in what? In S company. On the S company, how much investment are we making? We are exchanging the shares of the 750 shares times how much the market value of the share. The market value of the share is $60 per share. So how much do we have? We are giving them the common, not cash, common stock in that exchange. We are giving them the common stock, which is the 750 shares times the par value of the $20 par. We are getting extra other contributed capital. Here, other contributed capital. So how much do we have? Those with the calculator. And of course, you also said we can directly do this two here, which is the same. Remember, you have to take the $760 minus the 20.
Investment is a 45,000. Common stock is
45.
and common
Okay.
stock is a 15,000, and other
Okay.
contributed capital is 30,000.
30,000, but don't forget the word. You can do it two ways. You see,
Oh
I'm
yeah,
going to,
we have to minus it.
very good. So times 750 minus the how much they pay, 850, right? You can do that, or you can do it separate, right? But it's better to do it together, or you can do it separate, is the same. Then we carry the cash. So I remember, Fatima, you said this one is 45,000,
Yes,
and you said this
15,000 common stock,
15,000, right?
and then other contribute capital is 29,150.
150. Thank you. 150. Thank you. Any questions, please, guys, before we move to the second phase? Any
And
questions?
cash, we have to put at 850.
850 for cash, so that your debit will be equal to your credit, right? Your debit will be equal to your credit. Now we know one, we have to do some elimination, right? We have to eliminate some of the words. So part B is saying that, okay, any differences here should be allocated to the goodwill. So we can do the journal entry here ourselves. Now let's do working papers, right? We have to working papers here for the elimination here. Okay, so here we are going to debit the what? The common, eliminate the investment. So common stock in what? In S. They also have other contributed capital and the retained earnings. So other contributed capital, retained earnings here. So how much the other contribute? The common stock is over 20,000. So we know the common stock is 20,000 here. 9,500 here. Now let's see if they have the I think they have the non-controlling interest. And there's no non-controlling interest. I'll come back to do this one, but let's do this one here. So the first is the what? The purchases price. Purchases price that we paid for the company, which is known as the what? Implied value. Now, we know that there's no non-controlling interest here. So the implied value is the 45,000 of our investment, right? 45,000 of the investment, give me, okay. Now, non-controlling interest is 0. Therefore, our investment here is the what? The 45,000 that we put in. But we purchase 100% here. Now we have to take the what? What is the what? Less the what? The book value. Let the book, let me show, okay, let me see if I can. Book value of the company here, which consists of the what? The equity, the book value of the equity, which is the what? Somebody can add, or we can put here, 10,000 here, 20,000, sorry, the common stock is 20,000 plus 19,000. 12,000 of the other contributed capital, plus 9,500. So how much do we have? I'm going to change this one amount.
Is 41,500.
Thank you, 41,500. So based on that, we said this is the 41,500 here. So this is 41,000. So if you subtract, remember, 41,500. And this one is the what? 41,500 here. So let's see. Now, so this is what the difference. So this is what the difference between IV and the book value. So how much the difference now?
It's 3,500.
Okay, 3,500 here. So 3,500 here, 3,500 here. And what did they say? They said if there's any difference, allocate it to the what? To the goodwill. So we are going to put the goodwill here. Goodwill, which is the difference. So this one is going to be subtract 3,500. Subtract the 3,500. So that here is now 0. Is what? 0. Remember, here there's nothing here, but there's no non-controlling interest. So now here, the balance here is going to be what? 0, because we have allocated everything. So I can do it now. Let's do the working paper here. We know the common stock, we eliminated it, 20,000. We have eliminated 12,000, other contributed. We have eliminated the retained earnings of the 9,500. This one, we eliminated it against our investment, against our what? Our investment, which to credit the investment here, investment in the what? In the S company, 45,000. That create the difference that we did here. Difference between IV and the book value. IV and the book value. Which is the word, the 3,500. And what did they told us? They said if there's any difference, we should allocate it. So we have to eliminate the difference by debiting the word, the goodwill, crediting the word, the difference here. Between IV and the book value, which 3,500. 3,500. Now we can prepare. Once we finish this one, we can now prepare the B parts. We did the B already. C said we should prepare the what? The consolidated. So now let's prepare the consolidated and let's see what is going to happen here. We know that they have the word, the cash, right? So I need, can we add the cash? So the cash is going to be what? 36,000. $36,500 plus 6,500 minus the 850 cash that they paid, right? Which is right here. So 36,500, 6,500 plus the cash that they paid. So we have to know how much is that, and then we have account receivable 47 and the 9,500. So this is 47,500 plus 9,500. Then we have the inventory here, 29 plus 12,500. So 29,000. 29,000 here plus 12,500. I think so, yeah. Then we have the word, the PPE, 47 and 21. PPE, 47, 500 plus 21,500. Then they have the word, the land, 13 and 11. 13,000 plus 11,000. And then I have to insert one thing here. Insert the goodwill. The goodwill that we just created, which is now easy. The goodwill was 3,500. Okay. So can you give me the numbers if you guys are able to work it out?
Cash is 42,150.
42,150. Thank you.
Account receivable is 57,000.
Thank you.
41,500 for the inventory. 68,500.
68,000. Are you sure? because this is a 47,500. So it should be 69.
47,500 plus
Yes, it's
20.
69.
Yeah, it should be
Yeah,
69.
69,000.
What about this one?
24,000. Wait.
Okay, so how much the total asset now? So equal to the sum. Somebody should check the numbers for us. It's good? I think so. I think it's going to be good. We're good. So let's look at account payable, 33 and 9,000. So account payable here, 33 plus 9,000. Account note payable, let's see, 41, 10,5, 41. The common stock, we know the common stock already. So, the common stock here, we have, if you look at it, we have the 50,000 common stock, and we also give the 15,000 that we issue. So we have 50,000 plus the 15,000 that we issue to get a company. Other contributed, if you look at it, we have the other 30,000 plus the 30,000 that we receive here. And I'm going to make it 30 and subtract this one. Or you can just make it 29,150 to be easy. So we have 30,000. So this is 30,000 plus 29,150. 150 here. Let's see. Yeah, 29,150. Okay. So if you finish, you can give me the numbers.
Its account payable is 42,000.
42,000. Okay. What about the note? Oh, this is a
Is it
10,500.
1,500 or
No, 10,000.
okay.
10,500. Yeah. You're right. It's 10,500. It's not 1,000. Okay. So how much do we have?
It's 51,500.
Thank you. And then we have the common stock. How much the common stock?
It's 65,000.
Okay. And the other contributed capital?
59,150.
59. Then we have the retained earnings. The retained earnings, we don't care. We have eliminated. We have eliminated this one. So we know it's about 19,500. Now let's see. This should be equal to the total sum. So its balance is the same. Yeah. And it's the same here. Any question as we are bringing the class to an end? Any question? The floor is open for any questions. Any?
Hey, Professor, I have a question, but it's
Of
irrelevant.
course.
I just wanted to see when you'll be grading the homework.
Oh, this week. I promise that I'm going to grade it this week.
Okay.
Yeah, I'm going to grade it this week. Last week I was busy preparing for something, so I was not able to do it. But I promise I will grade it before Wednesday.